We'll be discussing more on the nature and scope of financial management. The second and the third will be discussed on the next video. The nature and the scope of financial management. When we say financial, this is the money we have. Or in Tagalog, ito po yung tumutukoy sa pera o kaperahan na meron tayo. Kapag sinabi naman natin na management, ito po yung pag-organize kung paano ba natin gagastusin ang pera. Ito po ba ay gagastusin natin ayon sa mga bills na nakapila sa atin kapag tayo ay sasahod na? Or meron tayong porsyento ng pera natin na inilalagay natin sa ating piggy bank or sa bangko? At meron din tayong mga pera na pambili ng mga gusto nating bilhin. So kapag pinagsama po natin ang financial at saka ang management, makakabuo po tayo ng salitang financial management. Financial management is broadly concerned with the acquisition and use of funds by a business firm. Its scope may be defined in terms of the following question. First is how large should be firm and how fast should it grow? Composition of firm's assets, the mix of the firm's financing, and the analyzing, the planning, and controlling its financial affairs. So, marunong ba tayo lahat ng mga bagay na to? Let me see. According to Wikipedia, it is the planning, acquiring, utilization, and controlling of financial resources or activity. It deals with investment decisions, financing decisions, dividend decision, liquidity decision, and budgetary control. According to R.C. Osborne, the finance function is the process of acquiring and utilizing funds by a business. We have here goals of financial management. We have the profit maximization, that is the profit after tax, and the maximizing earnings per share. In the profit maximization, this is the profit maximization, this is the main of any business or main aim of any business, and therefore it is also an objective of financial management. Profit maximization in financial management represents the process or the approach by which profits earning per share is increased. In simple words, all the decisions where investment or financing are focused on maximizing the profits to optimum levels. Profit maximization is the traditional approach and the primarily objective of financial management. It implies that every decision relating to business is evaluated in the light of profits. All the decisions with respect to new projects, acquisitions of assets, raising capitals are studied for their impact on profits and profitability. If the result of the decision is perceived to have a positive effect on the profits, the decision is taken further for implementation. So we have here the advantages and the disadvantages. Advantages: economical survival, measurement standard, social welfare, economical welfare. Disadvantages: haziness of the concept profit, ignores time value of money, ignore risk, ignore quality. Maximizing earnings per share, we have here the step of for achieving the objective of wealth maximization. The objective of financial management are such that they should be beneficial to owners, management, employees, and customers. These objectives can be accomplished only by maximizing the value of the firm through the following ways: increase the profits, reduction in costs, sources of funds, minimize risk, long-run value, good track record of dividend payment. Remember, wealth maximization is superior criteria than profit maximization. So here is the representation of the profit maximization versus the wealth maximization. Profit maximization, it does take into account time value of money. Wealth, it takes into account time value of money. Profit, it does not take into consideration the uncertainty of future earnings. Wealth, it takes into account the risk factor. Profit, it does not consider the effect of dividend policy on market price of shares. Wealth, it takes into account the effect of dividend policy on market price of shares. Profit, it does not differentiate between the short-term and the long-term profits. While in wealth, it considers the different strategies for long-term and short-term profits. Now let's move to nature of financial management. We have here the first one, estimates a capital requirements. Here, financial management helps in anticipation of fund by estimating working capital and fixed capital requirements for carrying business activity. Next one is decide capital structure. Proper balance between the debt and equity should be attained, such as minimize the cost of capital. Financial management decide proper portion of different securities, for example, the common equity, prepared equity, and the debt. The third one is the select source of fund. Here, source of fund is one crucial decision in every organization. Every organization should properly analyze various sources of fund. For example, the share, the bonds, the venture, etc. It must select appropriate fund which involve minimal risk. The fourth one is the select investment pattern. So before investing the amount, the investment proposal should be analyzed and properly evaluates its risk and returns. And the last one is the raise shareholders' value. It aims to increase the amount of return to its shareholders by decreasing the cost of operations and increase in profits. Finance managers should focus on raising the fund from different sources and invest them in profitable avenues. Management of cash. Here, finance manager observes all the cash movement, for example, the inflow and the outflow, and ensures they should face any deficiency or surplus of cash. Implying financial control helps in keeping the company actual cost of operation within limits and earning the expected profit. There are different approaches involved, like developing certain standards for business in advance, comparing the actual costs or performances with pre-established standard, and taking all required remedial measures. Let's move now to scope of financial management. Financial management cover wide area with multi-dimensional approaches. It plays an important role in overall management by dealing with various functional departments like the personnel, the marketing, the production, So, let me explain the scope of financial management as follows. Sorry. First one is the investing decision, the financing decision, dividend decision, and the liquidity or the working capital decision. Investment decision. The investment decision involved the evaluation of risk, measuring of cost of capital and estimation of expected benefits from the project. Capital budgeting and liquidity are the two major components of investment decision. Capital budgeting is concerned with the allocation of capital and commitment of funds in permanent assets which would yield earnings in future. The capital budgeting also involves decision with respect to replacement and renovation of old assets. The finance manager must maintain an appropriate balance between fixed and current assets in order to maximize profitability to maintain desired liquidity in the firm. Capital budgeting is a very important decision as it affects a long-term process and growth of a firm. At the same time, it is very difficult decision because it involves the estimation of costs and benefits which are uncertain and unknown. The second one is the financing decision. While the investment decision involves decision with respect to composition or the mixed asset, financing decision is concerned with the financing mix or the financial structure of the firm. The raising of fund requires decision regarding the method and sources of finance, relative proportion and the choice between alternative sources, time of flotation of security, and etc. In order to meet its investment need, a firm can raise fund from various sources. The finance manager must develop the best finance mix or optimum capital structure for the enterprise so as to maximize the long-term market price of the company shares. A proper balance between debt and the equity is required so that the return of the equity's shareholders is high and their risk is very low. Use of debt or the financial leverage affect both the return and the risk of the equity shareholders. The market value per share is maximized when risk and return are properly matched. The finance department has also to decide the appropriate time to raise the fund and the method of using the security. The next one is the dividend decision. In order to achieve the wealth maximization objective, the appropriate dividend policy must be developed. One aspect of dividend policy is to decide whether to distribute all the profit in the form of dividend or to distribute a part of the profit and retain the balance while deciding the optimum dividend payout ratio, that is the proportion of net profit to be paid out to shareholder. The finance manager should consider the investment opportunity available to the firm, plans for expansion and growth. Decision must also be made with respect to dividend stability, form of dividend, for example, the cash dividends or the stock dividend. And the last one is the liquidity or the working capital decision. Working capital decision is related to the investment in current assets and current liabilities. Current assets includes cash, receivables, inventory, short-term security. Current liabilities consist of creditors, bills payable, outstanding expenses, bank overdraft. Current assets are those assets which are convertible into cash within a year. Similarly, current liabilities are those liabilities which are likely to mature for payment within an accounting year. So, to give you more information about the nature and scope of financial management, let us watch this short video clip.
Just like you need air to breathe, your company needs cash flow to stay in business. Many small business owners avoid managing the money part of their business. This could be because it may seem difficult to understand. Financial statements look intimidating. It's more fun to work on marketing. They have hired a bookkeeper, or maybe they are too busy. It's important to pause and look at your numbers often. Your financials tell you about the health of your company. If you are feeling intimidated by financials, this video will help you master 3 key concepts. Our first concept is cash flow. It is important to know when the money comes in and how it is being spent. You want to ensure your bill collection and payments are on time. Doing this will help you stay on track and plan for emergencies. If you run a seasonal business like a landscaping company, your cash inflow for the entire year may happen in just a few short months. You will need to plan for costs, such as rent and utilities, when business slows down. The second concept is startup costs. To calculate your startup costs, list all expenses you can think of that might be required for starting your business. There is no magic formula beyond that. When you're in the planning phase, you may find some costs that aren't yet covered by sales. Knowing these costs allow you to know how much cash you should have in the bank before starting your business. Here are a few examples of startup costs. One-time expenses, such as permits, licenses, registration fees, logo design, business cards, website, down payment on rental property, and leasehold improvements. Ongoing expenses, such as rent, payroll, taxes, accounting services, insurance, utilities. Investment in assets, such as equipment, inventory, furniture, and vehicles. Finding these costs will allow you to know how much money you need to personally invest and/or finance to get started. Just add them all up and you have your number. See? That was easy. Our final concept is the break-even point. So you want to start recovering your costs, paying your expenses, and generating a profit from your business? You will need to know how many products and services you must sell and at what price you need to sell them at. To do this, start by understanding your company's break-even point. The break-even point is the point at which your sales will exactly cover your expenses. Determining the break-even point allows you to know the level of sales needed to cover all costs and start earning a profit. To calculate this number, you need to know 3 things. Fixed costs are costs that your business pays whether you have sales or not. These items include rent, taxes, salaries, and any other monthly expenses that do not change. Whether you sell 1 product or 20, you still need to pay these expenses. Variable costs are costs that change based on your number of sales. For example, raw materials, factory labor, and sale commissions. Finally, you'll need to determine your selling price for your product or service. Remember, whether you're just starting in business or creating a new product or service line for an existing business, you can adjust this selling price up or down as you start to calculate. Here's an example. Quality Totes Limited is a new company wishing to produce designer handbags. The company has calculated that it has fixed costs that consist of its utilities, owner salary, rent, and property taxes. Those equal $80,000 per year. Their variable costs are the raw materials, leather, fabric, clasps, 1 part-time contract seamstress, and 1 family member who has offered to work for sales commission. Based on this information, Quality Totes Limited estimate their variable costs will be $18 per bag sold. The bags are priced at $68 each. At this level of sales, they must sell 1,600 designer handbags per year to cover their total expenses. At this selling price and with these expenses, Quality Totes Limited will not make any profit unless they sell more than 1,600 handbags. They will only break even and cover expenses. Try this formula for your own business. See how cutting your costs or adjusting your price impacts how many products or services you need to sell to break even. Want to learn more about how cutting costs or adapting your price changes your break-even point? Download the Break-Even Analysis Worksheet in the Business Link online toolkit. Now, take a long, deep breath. You're well on your way to understanding how to manage your business's money. Learn all you can about the other formulas you can apply to your business by downloading all the financial resources from Business Link.
Thank you so much for watching.